My career in financial services has mirrored the evolution of the markets from, the old markets, open outcry, voice trades, faxes for confirmation, etc., moving through to electronic execution, then electronic execution with electronic back office, electronic settlement and clearing and everything else. And so I've kind of moved with that. I'd like to say I was always ahead of the curve. I can't obviously say that, but sort of there. So having been to business school in the States, or in Stanford, I went to work on Wall Street as an options trader. And in those days, there was no internet. There was no telephones, no mobile phones. And then it finally came in with the phones. So you had to have a car battery to operate. But you know what? We got it done. And when we were managing risk, for instance, I worked at the Bankers Trust at Merrill Lynch, we used Bloomberg a lot. Bloomberg had a lot of risk systems built into it at that time. So we became the early adopters and early experts on using Bloomberg. But I think the move towards faster, supposedly more transparent, easier markets also acts as an accelerator to those markets. When things go wrong, they go wrong very quickly, right? And markets move. I mean, today we're here in Boca, but the stock markets are being roiled. Credit Suisse this morning fell 30%. During the morning, recovered a little bit later on. So all the markets are collected, they're all electronic. In the derivatives markets though, I remember back to the Liffe exchange, which people don't forget was the largest exchange in the world for a while, and was one of the first that really started developing electronic trading. I think they were given a bit of a nudge by Eurex, who took the Bund contract away. Okay, so from open outcry, Liffe then evolved into an electronic exchange, prompted by Eurex, who was much more smaller specific exchange. But you may also remember that Liffe actually sold its technology to other exchanges, for example, the Japanese exchange, and became the subject of the CME finally moving to electronic trading, because there was a lot of opposition to it from the more established members of the CME. And it was only the success of Liffe and Eurex, I suppose, to some extent, that forced things through. There's a good analysis of this in one of Leah Malamed's books about, For Crying Out Loud, I think it was called, the book. And it's all about the change from open outcry to electronic trading, which is what we know now. On another level, later in my career, after working on Wall Street and trading, I worked the initiation of a company called BrokerTech. And BrokerTech was an electronic platform for US government securities and repo. And if you remember, Cantor Fitzgerald, with their eSpeed product, started the move towards that. And then BrokerTech was basically started to accelerate that process, but also BrokerTech was largely owned by the banks. The banks initiated starting it up. And the single biggest goal was to obviously make trading more transparent, straight through processing, straight to Fedwire, etc., netting, all those good things, and in repo. But more importantly, they managed to control the governance of the market, and they crushed brokerage outs for treasuries. When I started at Merrill Lynch, we probably paid $100 a million for treasuries. By the time I left, I think we were paying $1 a million. So a complete change there. And once the US Treasury market became electronic, then obviously other B2C systems like TradeWeb and others carried on, and since then you've had market access and everything in the corporate side. Throughout my career, I've kind of followed this trend going forward. I worked for the Hong Kong exchange after leaving NYSE Euronext, and again struggling there with some of the markets to turn them electronic. The metal exchange was a situation where a lot of the older style commodity houses didn't want to go electronic. They still had the ring, they still had all these things, and I think they were a little slow to change. I was put in there to try and speed that up and change it, and I think that it was always held back by the members and other things, even though Hong Kong Exchange paid $2.2 billion for the exchange. And I think, since then, I sort of retired. I'm on the board of various banks and tech companies, and then I'm now running actually a tech company called NovaFori, which works specifically on digitization of markets. So what does that mean? It means that we look at marketplaces and we look at auction technology that helps drive efficiency in more analog-based markets. A lot of our clients are not financial companies. They are real-world economy companies that can massively benefit for a more digital electronic approach. The amount traded online and electronically versus over the phone or everything has just exploded, particularly over the pandemic. So NovaFori now has a number of very large customers. We've grown the company quite a bit over the last few years. We're currently looking at a next generation technology project so that we can start to use more common architecture. And we're also looking to raise capital so that we can invest directly in markets and own the market with partners rather than just supply the technology. So there's a sort of technology theme through what I've done. I guess in some ways you've tried to change things. You've tried to sometimes go with the flow to make things happen. But I was talking to some regulators this week about how we have to protect these markets now from cybersecurity or from cyber attacks or from GDPR data breaches, this sort of thing. And I think the message came across loud and clear that the biggest threats to the system are the weakest parts of the link. So although a major bank may have loads of cyber protection and everything else, if it's using vendors that don't quite have the same standards, that's where the link's going to be. And there have been some instances recently where intermediaries and data companies have failed, and you've probably seen in the public comments about ransomware attacks, which are not good for the industry either. But I think the regulators are very concerned about that, and they're also concerned about opening up the transparency of the OTC markets, because I think the listed markets do a very good job at working together, making things work. I think on the OTC side, probably a long way to go. The shareholders of BrokerTech were the major banks, and they were fighting some of the larger, more established exchanges, shall we say.
Right.
And they asked them to make certain changes, certainly lower prices and a number of other things. So it was almost like a Trojan horse, like we'll set up our own exchange then and take you on, and then force you to enact some of the rule changes and some of the price changes that we want to happen. Of course, it's very hard for an aspirant exchange to take on an incumbent. You've got a massive amount of infrastructure, connectivity, you've got to have the technology, you've got to be ready. All the clients have to write to that code, they all have to change their risk systems and everything else to a new exchange. And it was just, always very, very heavy lifting. And I think that the major established exchanges did make some concessions, and then slowly it just went away. In the cash treasuries market, it was basically meant to influence the behavior of Cantor Fitzgerald and eSpeed and lower the rates there, which succeeded. And the same thing in the treasuries market, which, as you say, was on CBOT before the mergers. You've got industry initiatives that have to benefit the broader community, not just a certain group of players. And I suppose that there's never much attempt to really get real end users to use the exchange.
Yeah.
And so you can't make a market just with the owners trading with each other, can you? Competition's always good. I mean, I remember, when I was at NYSE Euronext running the derivatives business, we had 3 options exchanges in the States. I think at the time there were 12, all competing for the same sorts of business, little nuances. CBOE had indices and other things. Yeah. And you think, well, they're going to drive each other into the ground, but they didn't. They innovated. I think when you have high margins, a lot of exchanges have 60% margins, right? So there is room for changes there. But I think that innovation is not enough. You still need liquidity. Liquidity is everything, right? Because you can have the best technology and everything else, but unless you have good two-way flow, and I think it's all this planning of getting everybody down the chain involved. Because for a fund manager to sign up to have trade on a future exchange, there's a lot of admin, a lot of support, needs to go through lots of layers. For banks to take on new contracts, there's accounting, risk, controls and everything else. So I think sometimes, as you said earlier, it's more a threat than a reality to make it work. NYSE Euronext and Deutsche Börse were going to merge, right? We spent 2 years putting this deal together. And I remember at the time I worked very much with Andreas Preuss, who ran Eurex and I ran Liffe. And we looked at putting the two together to create a European champion to counterbalance ICE and CME. That was really one of the things. And it's very disappointing the European Commission wouldn't let the deal happen, because what they did is they handed the global status to non-European exchanges. That would have been good for Europe. So we spent a lot of time doing that. At the end of that, it didn't happen. Both exchanges had sort of opened all their books to each other. Everybody knew everything about everybody else. And it was a decision what to do for each partner. And NYSE Euronext decided to push together the cash and the derivatives markets together. And I said, no, you should invest more in derivatives. There's clearly more scope, in my opinion. So I left NYSE Euronext. I had gardening leave. But actually, I did work with ICE on the acquisition of NYSE Euronext as a consultant on various matters. And I could see that, in fact, most of the senior management of NYSE should be very grateful, because that deal did go through at a much higher price than the market level, and I think I helped get that deal over the line. I was invited to join the board of what was called Perfect Channel, the previous company, and then some of the investors asked me to look at a new business plan, good technology company, but not expansive enough in the business sense. I looked at a new strategic plan and they said, we really love this, would you come and run the company? And so that happened in January 2020. Obviously timing's everything, a few weeks before the pandemic. It was fun. And I decided to basically have a root and branch transformation, in the sense that we wanted to change the name to something more forward-looking. NovaFori means new markets in Latin. And I also thought that the time was right for concentrated investment in moving from what I called analog markets to digital markets. So that happened in 2020. Our revenues for this year just gone by are nearly 4 times what they were then. So I think we've grown it quite a lot. But we're actually really trying to grow revenues, then preserve cash flow, and then be profitable. We want to reinvest everything we do. So we're not taking any money out. We really want to push this forward.
Yeah.
And there's room. There's lots of room in lots of markets every day. We worked with a new exchange in Singapore, CIX, a Climate Impact Exchange owned by Temasek, SGX, Standard Chartered, and DBS, to auction carbon credits and to create a marketplace for them. That was in 2021. We also about to close some other auction type deals as we speak. We work with Lloyd's of London. We work with a number of car companies on auction protocols and marketplaces there. So I suppose it's different than running exchanges and markets, but it isn't in the sense that technology is at the center of all this. It's just a question of, is it functionality rich or speed? We're not about speed, we're about functionality. We're about trying to change outdated processes, and it's just a lot of upside. So we're raising capital at the moment so we can co-invest with partners in new markets and accelerate our next generation projects to have more common architecture, more of a SaaS model, if you like.